Every year, global leadership of macroeconomic policy converges right here in Washington, D.C. for the annual spring meetings converged by the International Monetary Fund, that's the IMF, and the World Bank on the other hand. Now, the 2025 spring meetings were especially critical for Kenya for two reasons. The first one being that Kenya's program with the International Monetary Fund, which has been running since March of 2021, had been terminated prematurely. And that, of course, meant some funding which should have been received in the current financial year, about $800 million, had been shelved. So the delegation from Kenya arrived here on a mission to kickstart a formal request for a successor program and its criticality on funding the budget for the financial year 2025-26.
The seventh review, it took inordinately too long. It was supposed to happen in March last year. It didn't happen. May last year, it didn't happen. July, it didn't happen. September, it didn't happen. A number of issues. I remember the issues of unrest that we had in the country and other unfulfilled conditions. So we actually combined the 7th and 8th review for October, which successfully went through. And so we got the funding around that time. We were expecting to get another $850 million out of the 9th review, 108 of which was supposed to go to BOP, or balance of payment stabilization or support, and the rest $742 million was supposed to go to the budget support. Now this 9th review, because of time constraint and some other conditionalities like revenue mobilization, which were not coming to fruition, it was mutually agreed between the two of us, the IMF and the government of Kenya, that we drop the 9th review and embark on the next program.
It is not uncommon at all, and there are several kinds of reasons why a country could decide to cancel an ongoing program and opt for a new one. In the case of Kenya, the authorities and the fund agreed that the 9th review of the program would not go forward because of the limited time left to be able to meet select key program commitments. And so the authorities then also have requested a new program which we'll engage on.
The second reason why the spring meetings of 2025 were especially critical for Kenya was that, whether by design or by chance, they were timed to coincide with President William Ruto's state visit to China. And when the president was in Beijing, he made some pretty strong remarks about the two institutions, that is the International Monetary Fund, IMF, and the World Bank on the other hand, and he's calling for what he calls a rethink of the global financial architecture, especially how the two institutions deal with developing economies such as Kenya.
At the heart of the Bretton Woods institution is a fundamental issue. These are shareholder institutions. At the time they were formed, the shareholders were also the primary stakeholders and beneficiaries. Both the World Bank and IMF have evolved into development finance institutions, but the ownership and power remains with the wealthy countries that they no longer serve. The interests of the shareholders and stakeholders and beneficiaries are at great variance almost all the time. This anomaly became apparently glaring during the IMF SDR issuance, where 64% of allocations ended up in wealthy countries that did not need liquidity support. The poorest countries, which needed it most, received only 2.4%.
You see, first of all, you need to appreciate that China is the largest creditor to Kenya in terms of bilateral loans. And as we speak, we have done very well with China, which is the leading lender. China, we have about 6.6 billion US dollars in total, all the loans that are owing to China. But SGR is standing out. and we have made progress. That 3 billion or so is supposed to be ending by 2029. Yeah, we have, out of that, $1 billion is concessionary loan. But there's $2 billion which is commercial loan. And this loan was taken in dollar-denominated terms, and then there is a markup. And so it is a bit expensive. We didn't take it in Chinese local currency. So China, being a very important and significant development partner in terms of bilateral loan, is a partner that we cannot ignore. We have always to discuss with them to see ways of how do we open the fiscal space to be able to do much more projects, because we still need to do projects. You have to get terms and conditions that would allow you the railway to pay for itself. So we are discussing a lot of issues with China bilaterally. And so it is not something specific. There are so many things that we are looking at. We are weighing the various options, which are the projects that needs to be opened up for future funding. How are we progressing with paying the loan to China? How best can we manage the liability in a way that does not put pressure on either China or Kenya without debt restructuring? Because debt restructuring is out of question. The moment you get into debt restructuring, you get to other complicated issues. We are also discussing with the China that what needs also to be appreciated is we need to open up our fiscal space to be able to do other very important projects, especially those ones which are supposed to help the economy grow. It could be the other possible facilities, and discussing their terms to be better terms or longer terms, or even talking about currencies. Are we supposed to, if we have to get into another program, can we get a project that is financed with the local currency, RMB, and what are the terms? Could they be much better? Which I'm told, yes, they are willing through China Development Bank, Exim Bank, that they could, if it is in their local currency, it could even be much, much more. And this is in line also with our medium-term debt strategy of diversifying currencies. We don't want to be over-dependent on one currency, that to the extent that if something happens with that currency, like right now, most of our debts are in US dollar, USD in terms of currency. I'm not saying that we are going to move away from USD. You can't. USD will still remain as the leading currency. But then we need to diversify so that if something happens to one currency, it doesn't affect us, it doesn't completely collapse our economy. So those are the things that we are discussing.
The tough talk by President William Ruto in Beijing about the Bretton Woods institution notwithstanding, when his delegation arrived in Washington, D.C., the first order of business was to sit with the IMF and figure out how Kenya can secure a successor program. Why was this especially delicate for the country? Because in the previous program, which has just been terminated, Kenya had hit the ceiling of its allocation. It had essentially maxed out on what it can possibly get from the fund. So I sat down with the governor of the Central Bank of Kenya, that's Dr. Kamau Thuge, and the Treasury Cabinet Secretary, that's John Mbadi, and asked them, how was Kenya expected to navigate this question of securing what you call a funded program, which means a program from the IMF which comes with financing attached to it?
It's not necessary that we have exceptional access, that even within the limit of the 600% of quota, we can still have an arrangement with the IMF, given the kind of repayments that we are making in the next 3 years. And we are making substantial payments, and that will create space to be able to borrow from the IMF without exceeding the 600% of quota ceiling. The IMF programs, the access normally depends on whether you have a balance of payments need and the strength of your program. So from the central bank point of view, I think we have built a fairly strong cushion. I think we have very strong buffers now, and I think that has offered confidence to investors, and I think that is part of the story of why the exchange rate is relatively stable. So really it would depend a lot on the strength of the reforms in maybe perhaps on the fiscal side. So the amount of quota or the amount of access that we will have to the IMF resources will actually more depend on the fiscal side rather than on the balance of payments needs.
When we're determining fund financing under a program, also on a case-by-case basis, but looking at the general criteria, those criteria are the balance of payments need of the member, the country, the strength of the program and capacity of the country to repay the fund, and the amount of fund credit outstanding. So those are the three factors shaping determination of access.
I don't want to talk about the amounts at the moment because we have to negotiate with IMF, and based on our fiscal framework. Right now we have not factored in anything in our budget for 2025-2026 for IMF, but I want to just report that our quota was increased. I need to get the amount the board increased our quota. So that is number one. Number two, you see IMF, we have also been repaying. So that opens up some space for us. Three, we had a facility of exceptional access last year, which we didn't exploit, we didn't use because the markets opened and we went to the market and managed our liabilities.
Now, the building right behind me here is the headquarters of the World Bank. And one of the issues which Kenya has faced in FY 24-25, which is the current financial year, is a delay in a disbursement from the bank, what we call the Development Policy Operation, $750 million. So that again was part of the agenda as Kenya's delegation came to Washington, D.C. for the spring meetings. I caught up with the two top bosses, that is the governor of the central bank and the National Treasury Cabinet Secretary, and they indicate that these funds are now expected to hit the exchequer coffers as early as the first week of June. That will mean it will have a headroom of about 3 weeks before the financial year closes to be able to bolster the external financing that Kenya has received in the current financial year.
We have held discussions with the World Bank. There are broadly two elements to the discussions. The first one is their assessment of the macroeconomic situation, perhaps with support of the IMF. The second is the implementation of some of the prior actions that they had discussed, particularly with the National Treasury. And as you mentioned, the conflict of interest bill was one of them. And I think that has been resolved. I think the National Treasury is working very hard to ensure that the prior actions are met. And then as we engage with the IMF in terms of the next steps for the program, then the macroeconomic element of it for the DPO could also be addressed.
The DPO also, again, the indications initially they were talking of the board meeting in June. The prior conditions, we have largely met them, and the ones that have not been met, we are working very quickly on to make sure that by early next month, by the second week of May, that we are done with those prior conditions. Yesterday we had an engagement with our director, the director in charge of our region, and he gave up as a promise that the third week of May they may push for the board to sit. So it may happen earlier or faster than we had initially thought or had been indicated earlier. or initially. So that means then we may access the DPO, the $750 million by early June. Yeah, so that would really help us in plugging the hole that we may have.
And that brings us to the close of our special report from Washington, D.C. on the spring meetings for 2025, which, as I've indicated, were particularly critical for Kenya for a number of reasons: the collapse of the IMF program, chasing funding from the World Bank, as well as the fact that President William Ruto was in Beijing, China on a different mission. But also, we can never close without mentioning that these spring meetings had a particular overcast from the Trump administration and what it means for the two institutions, that's IMF and World Bank, and for their future funding for developing economies. Julian Samboko, NTV, Washington, D.C.